Richard, thanks for joining the podcast today. I really appreciate your making the time.
Great to be here, Jeff.
Yeah, so I wanted to start, we had a little conversation before we started recording, and one of the questions I often ask is, something that you disagree with common wisdom, and you had a kind of contrarian point of view that I thought would be really interesting to dig into. So can you tell us what your contrarian perspective is of things that people get wrong generally in this space?
Yeah, I think, I've been thinking about how big banks and, many other lenders have viewed loans historically and currently. And I think that there's a sort of a prevalence of the thought that loans are real commodity products out there, and that volume and revenue and the economics are tightly associated with just pricing plays or, distribution plays, or the raw terms in terms of repayment, et cetera. And the more I was thinking about it, is I think that big banks have long held that, but I think the fintechs too have kind of an originate to sell model.
For sure.
They're packaging it and securitizing these products, originating to sell, like a true commodity. And I think there's a huge opportunity to differentiate through two things, is through an exceptional experience, which you hear quoted a lot, but I think more importantly is through really strong relationship management of that borrower throughout the life cycle. And as a reward for creating that differentiation based on the experience that a borrower has with the lending institution, with the product, not just in the account origination process, but all the way through while in portfolio. If should they experience financial hardship, how does the institution manage a borrower through that experience? That's the way to create true differentiation for the institution, for the product, and really kind of to earn the right to be a customer or a member's lender of choice throughout their life, as they experience various borrowing needs throughout the course of their life.
I feel like there's a lot there to dig into. When you think about relationship management, you talked about in portfolio and kind of hardships. I'd love to dig into that because certainly, particularly with COVID, that's been a very hot topic. How do we manage people who are in distressed situations? But I wanted to start with, are there things you're doing during the origination experience, kind of in the more upfront process that you think of as particularly effective at building that relationship or trust in terms of how you engage with the member before you're actually have them in portfolio? And then we can dive into the portfolio side too.
Yeah, I think you're right. If you can't get past that first step of just an exceptional origination account opening experience, you're kind of out of luck as it goes to any kind of loyalty play or relationship build. And so we've spent a lot of time over the last 12 to 18 months in two areas. One is sort of our credit box, which isn't the most visible place where you might expect a lot of attention to be from a member experience perspective, but to the extent that we can overlay, our credit models with other attributes to better understand our existing members or prospects, and sort of alleviate some of the hurdles that we put in place throughout the origination process, like conditional approvals with multiple verifications or stipulations that need to be cleared. I mean, Upstart, you guys are market leader. It seems like your 72% goes to 78%, in a matter of months. But I think to the extent that we can create more automated kind of decision without those kinds of stipulations, and taking the burden off the member and putting it on us through more intelligent credit risk models is one piece. And then the second part is it's kind of around. I just think it's so basic. It's really our direct to consumer model. And again, this is where, we all would aspire to be like some of the fintechs like Upstart in terms of the tremendous marketing prowess. But we, as a smaller, 400,000 member, $9 billion credit union, have taken leaps and bounds to improve our direct-to-consumer capabilities so that we're reaching borrowers when they have needs or with a propensity to want to borrow. So we're not hassling our members or prospects who have absolutely no need, for the product based on our targeting criteria or our understanding of their existing product ownership. And then we're pulling them into a much better digital experience. So, this is where I think all the action has been on that account opening experience. And so we've played a lot of catch-up ball over the last 12 to 18 months. We've put in place that whole kind of soft pull pre-qual check your rate capability for auto loans and personal loans and credit cards, which is pretty advanced for a credit union our size. And then we've also invested very heavily in our digital application with sort of new architecture to enable all these third-party integrations. So like many others, we're using income and employment verification through some of the other providers like Plaid and Finicity. We're getting Kelly Blue Book values from for our auto loans. So it takes the burden off of the applicant, and there's more certainty around the valuation of the collateral. And so I think we're set up pretty well in terms of who we're sort of reaching out to, and then how we're engaging them into our franchise through a much more modernized and seamless digital account opening experience.
I love those two things, the direct-to-consumer model. Your point about targeting the right person with the right offer, not bothering them, and knowing kind of when there's a need or a propensity is so critical. And then I want to ask him one more question on this credit box, and some of kind of tying into what you said earlier about becoming the lender of choice. Are you finding one of the things I've been very curious about, because many financial institutions kind of really need to have members that interact with them multiple times from a financial point of view. It's obviously one of the objectives that when they need a loan, they're coming to you. Are you finding ways to leverage your knowledge of the consumer who's already a member in terms of either targeting or from a credit box point of view, ability to make the right offer to them because you know them better than the guy on the street who's sending them a direct mail or a digital ad? Like, they've been transacting with you for a while, and it feels like that ought to turn into not only trust, but the ability to better understand risk, make a better offer. Are you finding ways to kind of leverage those technology investments in terms of winning the repeat business by really improving the experience or the credit offers you're able to make to those members?
Yeah, I think, there's a lot in there. So the first part of the question is absolutely we're able to utilize our existing member relationship information, be it tenure, depth of product ownership, any derogatory,
within
records
the file
on their credit with us. So we've incorporated that into a custom relationship score, which is part of our risk model. And so as a result of that, it's exactly where you were going, Jeff, is I like on the friction side, we're able to know our member better, and so we're not asking for as many stipulations. But we're also able to have better pre-approval rates with our existing members, and to offer. So we're offering more credit accessibility, and also much more significant line assignments associated right with those offers, and I think we're also doing some things in portfolio. We call them top-ups too, right? So as we're seeing the payment behavior on, say, an existing personal loan, then we'll reach out midterm in that, and with that information, be able to offer additional extensions of credit where it makes sense.
That makes it. It reminds me of you say some of this is not rocket science or not complicated, but I was just talking to my kids this morning and reminding them that a lot of winning and success in life is not about doing the complicated thing. It's about doing the basic thing well. and actually executing on that. And as simple as it may sound, the number of institutions I talk to that don't have good current customer scores, or at least can't incorporate them in terms of reducing friction or extending better offers and pre-approvals is real. And it's great because I think that is there. I did want to go back to the at first you talked about expanding the origination, but also the servicing, and talk about how you think about that focus on relationship and trust extending into the servicing. I'm sure COVID has given you many examples of ways to deal with that in terms of hardship programs, but how do you think about, in the context of the portfolio and the servicing experience for existing products, that establishing and maintaining a strong relationship with your consumers?
Yeah. Sort of the premise that we're built around, and this is our really established charter since our CEO has been on board 5 years ago, is really doing everything that we can to promote the financial health and well-being of our members, and that's the core of our mission and our point of differentiation versus much larger, much more well-capitalized institutions. So we have to bring that to life with our membership that in every interaction, and so the loan is a great interaction for us to begin doing that. And I'll give you one example, Jeff, is we have a feature called Level Up. So let's
Level
just
up.
say,
Okay, got it.
yeah, let's say you came in into Patelco and you didn't have stellar credit, and so we risk-based price. And so let's just say instead of our best rate of 299 for an auto loan, you ended up with a 499 auto loan. Well, with Level Up, we assess your payment behavior every 12 months, and with 12 consecutive payments, we'll reduce your note rate by 50 basis points up to either the best rate we offered at that time or a maximum of 150 basis points. So in that life cycle, we're trying to do everything we can to promote great payment behavior and making it worthwhile, in terms of some tangible value that can actually save our members some money. And then, you were making a point about sort of the basic things. Well, I think one of the things is there's a balance between standardization and customization of offerings, right? Because you're looking for both efficiency as well as member centricity. And so if I had my druthers, I would, from a payment perspective, I would put every borrower on auto pay, right? And just eliminate a lot of the noise that comes in around, statementing, remittances, managing, posting payments, all that stuff, right? But, some of our members, are uncomfortable with that because they may have lumpy cash flows, or they may literally be living on a paycheck to paycheck perspective, and are making some decisions and may have to actually borrow or go into overdraft or whatnot. So we offer just a lot of different payment options. So, and that might seem just really simple, but you can, pay by branch, you can pay by phone. We have a fast pay digital service, so you don't have to be enrolled in online banking to pay through an off-us transactional account that you hold elsewhere. We try to make it easy, and we send out alerts, right, so that those who aren't on auto pay, will have an opportunity to, at least plan 3-5 days, however they want to set their alert, so that they're not in jeopardy of, missing a payment or, potentially having some negative impact to their credit bureau. So I think that's on us to make sure and sort of manage the borrower so that they're doing everything they can to maintain their credit responsibly with us, and if and ideally actually improve their credit scores. They pay down their debt and have more trades.
Interesting. This concept of the level up is fascinating to me. I could ask you a question about this for a long time, but how do you think about the economics of that? Because obviously there's, any lender who makes a loan to a slightly riskier consumer, you've got some defaults in there. You have to earn the interest for the overall portfolio on those that don't default. And so in some ways you're kind of almost refinancing your own loan down to a lower rate and reducing your returns. How do you think about modeling that financially? And I'm really curious how you get the institution focused on products that are financial wellness oriented? Because I can see many institutions going, hey, what number of people are going to get refinanced off us at a lower rate? And if that's not happening, forget lowering the rates. We took the risk. Let's take the profits. Forget it. And institutionally, if you're managed at a top line or bottom line revenue perspective from a compensation, like that's the thing that would make sense, not just from a shareholders return point of view on some level, but also from a, my compensation point of view as well. So I'm curious how you think about aligning the institution around an objective like financial health and getting people to put offerings like this in place where it can seem kind of counterintuitive from the institution's point of view and maybe from the individual manager's point of view that would be, a good thing to do, even if it's the right thing for the consumer.
Yeah, there's been, I think, a lot of work and research done around the economic value that's associated with financial health and financial well-being. And hey, I think Upstart's right there, right? You say 48% of adults don't have access to prime credit, and so
Prime credit, yeah.
I mean, if it's a $2 to $4 trillion marketplace, today, I mean, you're talking trillions of dollars of potential market value out there. I think because it is financial health and well-being is the core differentiator for us, and that's part of, that is our purpose. We've actually been part of Gallup's consortium around their financial well-being metric. So that's how we benchmark to peers. And
can you tell us a little bit about that metric for those who are not as familiar? Like what does that mean? What does it look like?
Yeah, it's kind of a fuzzy metric, right? I mean, I think a lot of institutions focus on net promoter score as the real way to become, say, a bank of choice or a lender of choice. And this math being simple, right? You get more promoters than detractors, then you're going to get more referrals. But this is softer in that it really measures how well a financial institution, and there's banks, credit unions participating in this consortium, how well an institution does along promoting financial well-being to its customer base. And it's really asked in a couple ways. It's asked via survey is how comfortable a member is in approaching their financial institution about issues related to financial health and well-being is one. The second is, do they really believe that their institution has their financial health and well-being at interest? And that's that's an index score. And so what they've found is that those institutions that track high on that score actually have greater depth of product engagement and participation.
Interesting.
Hence, greater economic value. And so we've been part of this for about 18 months, and we're at the top of the leaderboard in terms of our we call it the support index. And so it's a bet that we are making, and we're making it through really creating an experience or products that provide financial health and well-being through an experiential dimension or through actual product ownership versus, say, literature or access to webinars and all kinds of financial health and well-being information. And example of that, Jeff, is on the deposit side is we have a reverse tier money market where we're trying to promote savings behavior. So for the first $2,000 that saver puts into a money market account, they earn 2%, and then it tiers down at various tier levels down to more normalized market rates at, say, 25 basis points at 15,000, et cetera, et cetera. So we're really trying to promote positive savings behavior, and that's behind the spirit of Level Up, which is the product we just talked about on the lending side. I would say that so there is that sort of notion, and I guess increasingly corroborated view that financial well-being does translate into greater product depth and lifetime profitability. And the other thing along that is that on the lending side, the Level Up, now we have ridiculously low delinquency and charge-offs on our auto portfolio, and we have more than 80% of all those enrolled in Level Up have actually received that benefit last year.
Wow.
So there's a hypothesis here, and we have, I think, more analytical work to do around here. But I do contend as a hypothesis that these types of incentives and products actually are influencing our repayment behavior and driving, better delinquency and loss performance, which again is higher economic value. So less servicing expense, less cost of credit, et cetera.
Yeah, that's two ways to earn that point or two you're giving back, right? One through better delinquency and one through better relationship. That's really interesting. Got to think about what I want to ask you next. That's a really interesting topic. I liked your comment about not webinars and informational things around wellness. So I'd love to dig. I think of that as the lecturing at somebody problem, or what I sometimes refer to as the eat your broccoli problem. Like, I'm going to tell you what you're supposed to do. And, my kids don't want to eat their broccoli any more than anybody else's kids. And I'm like shaking a finger and forcing. And that, it seems to be the approach in general, if I had to describe it, the most financial wellness products or fintechs or others, the approach we take is we're trying to get a somewhat unnatural behavior from the consumer if it's savings versus investing. How do you think about that? I mean, this seems like, the savings idea of, more for the first couple dollars you get in, so there's a real issue. Are there other examples of how you approach that? Because it's a really interesting, different perspective on how you encourage the behaviors you want and invest in having your members become more financially healthy, which I think is a goal we all have, but maybe not one that's well executed on in many instances.
Yeah, I think this is getting back to the relationship component, which it does bring into that element of trust and is my institution actually a trusted advisor on some of the key financial decisions that I may have to make, whether they are while things are going great in my life or while I may be experiencing some hardship. Is my institution there, looking after my relationship with them for the long term? And so I think one of the things that surprised me coming here from a big bank was we don't have a collections department. And I say that kind of facetiously because it's actually called account solutions. We have delinquency managers and collection agents, but we don't call them, a collections team. They're an account solutions team. So our first real role is to help a borrower who may be experiencing some hardship to manage through that hardship and come out better rather than worse, or to optimize, the outcome. So we can provide a lot of solutions there that I think are differentiated. Like we have this skip a pay feature, which allows a borrower to skip payments up to 2 times a year for the life of the loan. And then we also have 2-month deferments. So then that allows a borrower to take a two-month deferment twice during the life of their loan. And so let's just imagine you're a auto borrower and you have it's your main form of transportation, car breaks down, you got a $1,500 expense. Well, if you called into Patelco with that hardship, right, we've got this program kind of in anticipation of some unexpected expenses that we can accommodate that hardship with no impact to the borrower's credit history, and an opportunity to understand more about that member and potentially even put them into one of our third-party. We have a partnership with a firm called Balance. It's a third-party financial wellness and advisory firm. So we pay them to provide this service, and they cover everything from saving and budgeting to how I can look at my credit score, et cetera. So it gives us those opportunities, and that's why we really call collections account solutions. And again, I know everybody's having exceptionally low delinquencies and charge-offs these days, but I think our practices are helping, and our members are increasingly viewing us as the institution that has their back and is in it for the long term with them. From a membership growth perspective, we've been 8% plus in terms of membership growth for the last 2 years, which is that ranks number 1 among our peer group for like-sized credit unions. So I think we're getting a lot of brand momentum around our financial health and well-being promise, combined with this kind of relationship view. I mean, the other thing with Gallup is they have a problem incidence score, which is, so that's where it really sort of measures as a percentage of respondents who had a problem. And so that's something that we manage aggressively, both the problem and the resolution. So
Yeah.
so it gives us that data point.
That's interesting. And tell me a little bit about the 8% growth, because I mean, I can't say that I talk to any financial institution who doesn't say growing my customer base, my membership is high on my list. I mean, do you have anything that you attribute that to outside of this focus on relationships? And I do think the last 2 years in particular have been a great time to earn trust. I mean, people remember how you treat them when they need the help, more so than how you treat them when, you know, I'm going to buy a house, everybody wants to do my mortgage. Great, that's nice, but like when I need to miss a payment and I've got a tough time, like they remember that, and I think that really does. It's a moment where you can earn loyalty. So I'm sure that has been great now, but I'm curious outside of those things, if there's anything, the things you've seen that have been to which you can attribute some of the growth that you think are lessons you've learned in that space. Because certainly it's something I hear a lot is like we need to grow our membership. We need to find ways to do that, and it's I think a challenge for many institutions.
It is an amazing thing when your customers really become your greatest advocates. And so we've been running for the last 3 years Refer a Friend program with certain incentives in place for both the referring member and the new member. And I think that was pretty timely, especially in the COVID period, because a lot of our programs, so all the COVID hardship programs that we put in place in terms of loan deferments, workouts, et cetera, fee waivers, all of that activity, emergency loans, really created a lot of advocacy for our existing members. And so we've had just phenomenal success with our Refer a Friend program. And what surprised us tremendously is that it wasn't just kind of a thin relationship that we were acquiring with the Refer a Friend for the incentives. We were actually seeing greater participation in other ancillary products from those new referred members than in some of our other traditional membership acquisition channels. So that's for sure, one of the big things. And I think this is kind of the piece around personal versus sort of all, or I'll say representative assisted programs, or having access to people versus pure self-directed engagement with the financial institution. So I think we've had an ability to sort of stitch together certain processes or disconnects for members through some of their challenges, where I think some of the digital-only plays don't necessarily have that luxury, and that's carried over into member goodwill, which has helped fuel not just referrals, but also fuel brand.
I wanted to highlight for that, Ian, one thing you said that was really interesting, and then ask you one more question before I let you go. But the Refer a Friend is driving deeper engagement among products than traditional acquisition channels. That's a fascinating reality, that when you can turn your customers into your advocates, not only can they help you acquire, but those relationships end up being deeper and more meaningful, which makes sense. I mean, when you get a referral from a friend, you trust that more than the billboards you saw, or the $500 in a toaster you got for opening an account, or what the 25 bits on the mortgage from the bank that you never had an account with for opening the checking account, that you're like, okay, I'll put the $100 in for the 25 bits because it's a mortgage, but like, how long does it have to stay there before I lose my 25 bips if I take it out? So that's fascinating. And then I also want to highlight this last comment you made. I thought you described it as self-directed versus being able to talk to somebody as opposed to digital. And I think that's so important, that we tend to think of digital as being purely self-directed. but this sense that, you didn't break it down as the digital, non-digital. You broke it down into a self-directed
Right.
and a human-enabled human touch. And I think it's a really interesting distinction from digital, non-digital to is it
Right.
self-directed experience, or is it maybe a hybrid experience where I've got human interaction despite the digital? That was a really interesting phrase to me, in a different way of thinking about what I think many people will just go, hey, it's digital or it's not digital, and digital being entirely self-directed at its core.
I'm super excited about where we're headed on that front. And I think obviously COVID was a big sort of impetus behind all of this, because literally our branch coverage was compromised. And so we have launched the virtual branch, which is a way for our membership and prospects to engage virtually with one of our team members through a video capability. So we're able to sort of impart we're able to sort of have a more rich interaction with a member in terms of understanding their situation and solutioning much better. And so I'm excited to see where that goes as relates to more of a hybrid model.
That's really interesting. I find I'm hearing more and more of this sense that we want the human interaction for the advisory, for the solutioning, but then often it's like, okay, I figured out what I want. Now, like, I don't want it's like when I'm in the store, somebody comes, helps me out, and then they're like, walk me to I'm good now. Like, I appreciate the help, but like,
Right.
I want to go back to what I was doing. I can take it from here. And I think that ability to have that hybrid experience where you can inject the human touch and then allow someone to self-direct from their couch to finish a process and upload the pay stubs in piece or whatever they have to do is a really powerful model. It sounds like you guys are taking some interesting steps in that direction.
It's just great to give members and customers choice so that they can sort of engage and transact how they want to. It's kind of like the payment thing I said. Like everyone, I mean, I'd like ACH, but some members may not like that. So It's nice to have that flexibility. And I get frustrated when everything I want to do from an investment perspective has to go through one trusted investment advisor. It's, sometimes I might want to, so I've actually had to create my own kind of play account just so I can just sort of
Yes, you could do
guilt-free. Do what I
want to take this stuff. Just leave me alone over here.
Right.
I like it. Well, Richard, I always close the podcast with the same 3 questions, but before I get to those, was there anything else you wanted to talk about or questions you wished I'd asked, areas you thought we should have delved into and didn't? No is okay. It just means I did my job well in preparing. So I'm okay with either answer, but I always like to give my guests an opportunity to highlight anything that we didn't get to that they thought was relevant or useful.
Well, I'll just say that, look, I do think that, there's so much hype around machine learning and AI, and I just think that we could be losing the forest through the trees. The key is just intelligence, right? And especially among financial institutions, in terms of how we operate our businesses as it relates to, we started off by saying, who do you reach? And we need sort of more sophisticated targeting models. And I'm not talking about just simple waterfall models. I'm really talking about like propensity models, and same with, how we manage risk and credit risk. I just think, that is where, at least Patelco, we are just focusing very heavily on increasing our data sets. I'd really like to find some way to incorporate more behavioral attributes into our credit risk modeling, so it's not just hard data, but what we're seeing in terms of actual attitudes and behaviors, and incorporating that into some kind of scoring. But I think that's kind of the next cool front. I mean, well, it is the cool front already.
We agree with you on that. It's a pretty, and it is. I've always been a little surprised that I went to banking conferences for years. I still go, but for years I would go, and AI would just be like the chatbot. Like what they meant was replace the banker with the bot. And I went, well, like I actually think there's a lot of interesting stuff in ML and the targeting and the credit scoring and the propensity and and then like the consultative conversation about what product is the best fit for you is like a place where the humans are still doing better. And we seem to be really focused on taking that human out of that part of the equation, as opposed to your point, going, hey, can we have better behavioral models, better propensity models that can help us find the right consumer at the right time, make a better offer, understand that this person's credit worthy when maybe they don't have the best credit score, and extend them credit. And I was like, man, you guys are misapplying. We seem to be focused on this thing that's, I think the humans do well, and not as much on this other area where I think there's a huge opportunity for machine learning models, data to improve outcomes. And that was just, it was frustrating me for years. I think you're right. There's a shift, and people are looking at some of the other stuff now. But it was amazing. Like, for every year, it was just chatbots. That was going to be it. The branch is gone, and the chatbot is ascendant. And I felt like there were some back office opportunities that were just a bigger opportunity from an AI point of view, frankly, and one that was the technology existed, because the chatbots can do some stuff well, but when it comes down to, hey, I don't understand my mortgage options. What's the best choice, or I need some investment advice, like how should I think about an IRA versus a Roth IRA versus my 401k versus a 529 for my kids? Like you need a human to walk you through those options, and I think that was maybe not the best place to be putting the applying the technology.
Maybe you were going to those banking conferences at a heavy cost cutting era.
I've been going for quite a while now. I mean, came from the technology space, so I needed to learn the industry, and that was a good way. But there was definitely a year or two where I felt like that was the conversation. Anyway, I appreciate you saying that, because I think it's a good one.
Yeah.
So anyway, these are my final three questions for you, Richard. And I kind of do them, I won't say rapid fire, but in quick succession. But I find them to be pretty interesting. So what's the best piece of career advice you've ever gotten?
Well, we've talked a lot about it, and I actually do remember.
Just means you're putting it into practice, which is great.
Yes, a mentor of mine said, like, I thought it was a pretty kind of interesting thing when he said it. He said at the end of the day, the economic value will be held by those who own the member or client relationship, and products and services are in fact commodities. It's a little bit against what I'm saying. I mean, I think loans are more than a commodity, but I think the loans are transformed out of commodity by that relationship management component that we talked about. So I thought that was interesting. Now, I mean, this mentor was also a former McKinsey consultant, so it sounds like something a consultant.
It's got a good soundbite, fits on a slide
right?
nicely.
Right.
Yeah.
Right.
All right. My second advice. I guess that's kind of the best piece of advice we've got in consumer lending as well, as career advice and consumer lending advice, all wrapped up in one. Unless you had something else you wanted to mention.
Yeah. So I also had a great mentor at a big bank I worked with, and his advice to me was always pretty blunt, and that was be bold. And so I've sort of internalized that as that is sort of your point of orientation. Is I think we need to be bold as our first position, and then we need to take calculated risks and understand those risks, and then the mitigants. So it could be everything throughout the value chain, whether it's revenue generation, product and development, managing the cost of credit and the risks, risk reward along that spectrum. But I just thought that was really provocative, as that should be your first position, is to be bold. And I think a lot of big banks maybe lost a lot of that with sort of the age of compliance and regulations, and sort of credit risk phobia. And so I just think that's where the innovation comes from across the value chain.
Fortune favors the bold.
Yeah,
I like that. So in that vein, do you have a bold prediction for me about the future? So you kind of led me right into that one. I appreciate it with the bold.
Yeah, it's kind of scary for big financial institutions. I just do think that there's just greater disaggregation of products and services. So that's just going to happen, be it to big data firms, big online players, big merchants. I mean, you saw the markets team has gone over to Walmart. They're going to give a bank charter another crack again. Maybe it was before their time when they tried it. I think it was in the 90s, early 2000s. But I think that does go back to who owns the relationship, right? So, Amazon owns the transactional relationship for a big chunk of this country, and to the extent, they started off with just a narrow, book vertical, and so they've expanded it to multiple products, and And it just won't surprise me if there's greater disaggregation and sort of dilution of the revenue pool for financial institutions going forward.
Usually when there's some disaggregation, there's a reaggregation somewhere else, and you got to figure out how to participate in that. But interesting, disaggregation is coming. I like it. Well, Richard, I appreciate your taking the time today. This was a fascinating conversation. I'm sure our listeners will greatly enjoy. So thank you.
Great chatting with you, Jeff. Take care.
Take care.